This is the period that everyone starts speculating. Is the property market continuing to perform, or will it continue to perform or not? Now, why is this the period? Because usually after a drop and a significant rise in a property market, people start looking at it and speculating. They start giving opinions, setting emotion, reading articles, and listening to sessions and videos like this, and start having creating opinions and developing it. And in general, it develops with no or with little fundamentals and little numbers. So they believe this said. In other words, if someone in an article or in a video like this said 23% drop in property market is expected within the coming year, they develop and build on that because they believe that whoever is saying it is factual and have checked his facts and really knows the truth. Now, even people who possess fundamentals and facts may have a truth that's technically right, but no one really knows what happens with the market. At the same time, your friends who may be doctors and artists and automotive traders and architects and engineers and very successful businessmen are not professionals in a certain field. They are professionals in another. So when you come and want to discuss and form opinions, I advise you to refer not to your friend who is an architect, unless you are forming an opinion about architecture. Refer to numbers. How do you refer to numbers? Today, I want to take you through a very simple way that allows you to refer to numbers and understand the market as much as possible. Now, there is data that's out there. There is data that's not out there. In Dubai, we're lucky. Dubai Land Department is making more data available by the day. Now, how do we look at the market and assess it? Do we just look at what is available on the portals, Property Finder, Bayut, and Dubizzle, and the likes, and we look at the top priced properties? So you go and search for a property and higher price to lower price, and you say, oh, it's 6.2 million. It's growing big time. Or do you just read an article, or do you just refer to even indexes that you do see in front of you, and you look at that index and you have a snapshot in your head and you start generating or formulating further or future linear lines based on that snapshot? I've seen a post some time ago, which I believe you can all see on Google. It's a snapshot of two same graphs, one that takes a year and one that takes 5 years into perspective. The one that took 5 years into perspective was a downtrend that is a killer. The one that takes a year into perspective was an uptrend, as if the market is booming. So taking a snapshot of a graph or a market performance indicator does not really allow you enough knowledge to continue the line, because it's not just lines, unfortunately, that work in certain ways. There's much more into fundamentals of economy into it. What impacts your property value? Today, if you have property or any other asset, I believe it's utility mostly that impacts its value. Now, if you have equities, it's returns and growth and further growth and companies compounding efforts and successes, as well as many other innovations that can play a part of the game, as well as market sentiment. And market sentiment allows companies that do not generate any revenues to be performing and to be performing in price growth at tens of multiples, but this does not happen in property at all times. The growth in property in general has a direct correlation with the returns on the property. Thus, it's the utility value, either rentability or the livability and the kind of availability of such property and the demand on it. So next time you look and you want to speculate about what's coming, and no, I will not be speculating in this session, about what's coming, you need to look at the fundamentals. So the first thing you do is if you're looking at a certain area, you need to look at what took place in that area within the past period. Now, you have few indicators. None of them is fully decisive. However, there are things to look at. One of the indicators that you need to start looking at is not property directly related, is economics related, and is population related. And then we look at an indicator in property and we try to connect them with each other. The sum of those indicators can give you a clear version of a truth, not the truth, that may signify what may happen in the market for days, weeks, months, and may turn out to be true. How do you look at that? First, look at the economy. Is the economy growing, expanding, or shrinking? And is it growing because there is a bubbling neighbor? Is it growing because it's starting from a very low? Why is it growing? And how fast is it growing? And can it sustain that growth? That growth is in economic numbers, performance, GDP, as well as the population growth and the workforce growth. You need to look at those indicators. Now, then you look at the population growth. And for those who ask me, yeah, but how can I see population growth? There's no such studies in all countries. I'll tell you, for example, in Dubai, there's something called population clock. It's online. You can go and check it, and you know exactly what's now. I don't want you to build the future of your strategy based on that, but that's part of the indicators of how many people are in Dubai today, how many people are registered as residents, as UAE nationals, and the likes. So you need to look at those elements whenever you're looking at the economy that will serve your property, that will feed into your property utility value. Now, then you look at the supply of property. Now, in markets, some markets, there is tight supply. Like, for example, in France, like another example, which is the best of those examples, is London and the UK in general, but London in specific. And there's a shortage there since 1989. And that shortage they were never able to catch up with that shortage because of planning restrictions and other restrictions. So, if you take such a market, the weight that the supply has on the market prices is huge, is much bigger. And that's why supply and demand may be one of the biggest contributors. While if you take markets that are based on sentiment and growth, younger markets like the UAE and the Dubai market, you do look at that, but it does not have the biggest weight within the calculation, within the basket of elements that do impact your prices and your performance of asset, because there is others that do impact it more, and because the market is expanding and because the economy is expanding much faster, and sometimes it can exceed or not the supply of property available. So that's the second thing you need to look at. The third thing is fundamental changes in the structure of the country and the economy and the economic contributors. For example, if all the automotive companies started looking at UAE to open factories, you know that kind of investment is long-term, yet whenever it starts producing consistently for a consistent period of time, at the same time it gets you certain kind of workers and workmanship that do support the economy. Well, they get significant numbers, and that's significant to an economy. At the same time, they sustain them for a period of time, because opening such a factory or an assembly line has very high cost and is usually a significant investment for the company. So when they do it with proper research and with very extensive view into the future. So that's a second contributor. So you look at the contributors in general to the economy, and you see, and that's partially here in each of those, you have opinions that you're laying around, but the opinions you're laying around here are logical rather than emotional. Logically, this is how it is. This is how it turns out to be. And then you look at After the supply, you look at the types of supply. So for example, if somebody tells me, would you buy a villa or an apartment today? I have my own opinion. I'll not say it now. But because it needs a discussion that will take most of the session. However, you need to look at the kind of supply and the kind of demand and why is that happening and how would it span out to be. Now, again, none of those contributors you're assessing similar to how you do usually as the only contributor. So you talk about one of those and you say, this is why the market will do so and so. So because this is part of a basket of contributors, its impact is less. Thus, your possibility of having a mistake that's devastating is less. Then you look after that at the something called replacement cost, the cost of development. Now, remember, properties can go and drop below replacement cost. However, below replacement cost, on when you reach replacement cost, developers do not see it feasible to launch property. Now, some developers launch experience property. Some sectors of the market continue living and surviving. But in general, contractors cannot survive in that atmosphere, and developers cannot survive in that atmosphere. So you know that there will be a turnaround of some nature, but you have at least a benchmark of safety there. Then you start looking at the returns and the growth of returns, and you look at the kind of inflation that's taking place, and is that growth alongside inflation? For example, I have a theory that says that for people who say that, property prices on, for example, Palm Jumeirah are way overpriced, or in downtown or whatever. Now, yes, we can compare it to metropolitan cities and to prime areas all over the world that offer the same. And yes, we can tell them Dubai is one of those cities. However, I have a simpler rule and thing that I look at there. My theory, and I'll tell you why in a second, says that there has been very little real growth in the Dubai property prices in those areas for the last 20 years. Why? Because in 2004 and 2005, which is 18 years ago, 17 years ago, you used to be able to purchase a property on Palm Jumeirah for approximately what you are able, if you average out inflation, compounding inflation over time, purchase a property at today. So if you take this number that you purchased today at, you rewind it with inflation globally and locally, and the compounding effect, you approximately reach the same number. That means there's nothing of significant growth. Now, yes, the economy is growing. Yes, the country is growing. However, if you look at it 20 years ago, there was nothing there. There was no palm even. It was the freshness of the palm. It was just there, and parts of it were just a concept to date. There was nothing around you in Dubai. There was very little to do. Yeah, you had a 2-3 day vacation, some time on the beach, and then you get bored. Today, you can have a 30-day vacation and you wouldn't see all the attractions in Dubai. This is how much growth have happened. So if you look at the whole of the surrounding, it's a giant achievement. So from being a city that you would want to have the sun and the beach for a few days on, today, there's much more to do. And seriously, we can't catch up with what's happening in Dubai because it's a huge. So this is another contributor. Then you look after that at the specific area. So you go local. Rather than the helicopter view you're looking at the economy or the market condition and the market supply, you go local. You see what is there as a value proposition there. Who's my customer tomorrow? If you're manufacturing a good, you need to look at who's my customer tomorrow if you want to still hold that factory tomorrow. Now, you look there and you see who's my customer tomorrow. So is my customer tomorrow just the tourists, or is my customer, and then with less tourism, I'm doomed? Or is my customer tomorrow either an executive or a tourist? Is my customer tomorrow only a bachelor, or it's a family or an executive? It can be a bachelor as well, an executive bachelor, as well as tourists. All of those are contributors that you need to look at. And then when you look at those, you're able to assess into the future without trying to time the market and milking it. Now, timing the market, some people logically, I've been told by someone I'm very proud of a few days ago that give me your view because you were the smartest timing the market over the past years. And I would say I was lucky. I wasn't timing the market, however. I wasn't ever arrogant and trying to milk the market here and there, the last 5% of the market, up or down. However, I was logical about looking at the market, and I had right entries, right exits, and right holds, because you don't want always to be on the run. You want to have stability as well as grow wealth and profits with time. So for those asking about what's coming and speculating on what's coming, take this method. By the way, trust me, I'm sure that you put more than an hour of reading and of discussing every day to form your opinions. If you put this weekend 2 to 4 hours and you look at those elements each on its own and you go to the sources of each piece of those data, trust me, you will formulate a much better opinion, a much well-formed opinion. And then you can feel more confident about it, invest solidly, and purchase for the right reasons. Thank you all for joining me today. I hope you enjoyed this chat, and until next time.